กราบนมัสการพระคุณเจ้าครับ Good afternoon ครับ Now today I'll be talking on the topic of risk management, sustainable value for companies. If I may give a little bit of background, about 18 years ago, if you look from the top left publication list, Dr. Priyanut, who was at the time with the National Development Board, rounded up a bunch of us who were young researchers to look into the question of sufficiency economy philosophy, whether or not it would stand on its own as a body of economic thoughts. And so that was the paper towards a body of economic thoughts based on sufficiency economy. And then about 2013, at the time I was already working for the Siam Commercial Bank. The Siam Commercial Bank was involved in setting up this Sustainable Development Dialogue. This was some sort of a pre-stage toward the 2015 year when the Sustainable Development Goals became enshrined as an international commitment. And then after that, then wrote a paper that in a way explained how sufficiency economy philosophy as a body of economic thoughts and as a solution for humanity towards the problem of sustainable development or unsustainable development. And now this conference, as Prajan Anil said earlier, was originally about getting a bunch of us together and getting a publication. So my bit was about trying to tie in, because when you hear sufficiency economy philosophy, a lot of time is tied in with this concept of risk management. So it was about time that really I put down how those concepts stand. So it was risk management on the one hand, sufficiency economy philosophy on the other hand. But the way the paper was framed was, well, let's think about let's think about risk management as an objective and think of global sustainable development goals as an objective. How do they intersect? And the nexus was given by the sufficiency economy philosophy framework. Okay. But for today, I think what I shall like to do is stick pretty much to the script, to the title of the talk. Start with the risk management itself and how it relates to sustainable value. So the first part is a little bit about explaining what I do. My career is basically developed, mostly I spent a good 10, almost 15 years with the central bank, mostly dealing with risk management model. Okay. Now, and then how does it, well, exactly what is risk management within the context of a banking or financial institution setting, or in general, as a business concern, as a public enterprise, and so forth. Okay, and then I'll move on to risk management in relation to sustainable value. And this is where I might give some idea that maybe they don't always go together. Sometimes they actually contradict. Then I'll go to the idea of sustainable value as a mandate, as a global mandate in itself, and as a value proposition for companies. And see if at the end of the talk, I'd like to conclude with an open discussion on whether it makes sense to have this overarching theme about risk management and sustainable values for companies. Okay, first of all, risk. I just like to give a little bit of a backdrop. Risk here, the reason everybody is talking about risk is because banks started to talk about risk. And this was in the 80s. Now, risk itself, as a concept, this is a slide that says the evolution of concept of the notion of risk. If you go back to the Greeks, okay, risk was not something to be shunned from. It was not something to be avoided. It was looked at as some sort of heroic task. You don't become a Greek hero until you take on risk. So risk was something to be welcome, actually. It's a sort of something to be overcome. Now, over the years, actually can't see the second line. It's a bit too small, so I would imagine you can't even see that either. But evolution over time is this. You start to have this idea that risk is something that has to do with probability, okay? And so the mathematics, mathematicians, European, Western mathematicians in the 18th century, they started to have this idea of working with mathematics of uncertainty, mathematics of chance. They start to talk about probability, probability measure, and so forth. And then, of course, then you get to this age where you think of, well, if economic were to become an economic science, the way, say, physics and chemistry and geology was becoming a hard science at the turn of the 19th century, then economists themselves, they want to start to look at their object of studies, demand, supply, uncertainty, and so forth, in more mathematical terms. Okay? And so this was the era when economists, okay, we're still talking about economists, started to embrace the idea of trying to measure all things that has to do with human behaviors. And then at some point, we get into this kind of, I like to say folk wisdom, but actually it is part of a core mainstream economic thinking, which is that whatever gets measured gets managed. Okay? And that sounds like a brilliant idea. And in fact, this would be something that you would see in, say, Harvard Business Review. What gets measured gets managed. The problem is when human beings, we like to extrapolate beyond our area of comfort. And sometimes we have a lot of hubris. So we end up extrapolating a little bit too much. So at some point, the statement was, whatever gets managed, whatever gets measured gets managed. Becomes, well, economics dealing, or what does economics deal with? Economics deals with quantities which are probabilistic in nature. Well, mathematicians gave us way of measuring some kind of uncertainty. So let's just say that economic matters are measurable. Okay? And then you get from what gets measured gets managed becomes whatever is measurable is manageable. Okay, so it's two different sentences. One sentence says what gets measured gets managed. Okay, but the problem may still be too difficult to manage. But the hubris was, if economic science was put on the solid foundation of measurable variables, then certainly economics can be managed. Okay? So we start to think of economic system like an engine. Okay? If the engine doesn't run too smooth, you add some more gas, you calibrate, you tune the carburetor. It was that kind of thinking. And this, of course, transferred to the world of finance. Okay? So finance then, they deal with risk and return. It becomes the idea that, well, we can measure all the risk there is in financial investment, and we can always manage. So this is sort of the setting I would like to give. So sometime, originally when I was talking about sufficiency economy philosophy, especially to Western audience, I like to get their attention by saying it's a little bit like risk management, because I know that risk management gets their attention, they understand, especially people in the banking industry. But of course that is selling sufficiency economy short. Okay? As you see in my presentation, risk management is at best a very tiny subset of sufficiency economy. And at worst, sometimes it actually undermines what you're trying to do, which is achieving sustainability. Now, I'd like to contrast first. Now, we're still talking about risk. Risk in Buddhism is slightly different, if I may. I think in Buddhism, risk is not something to be avoided. Okay? Okay.
You can watch there in front.
Oh, yes.
Yeah.
Okay. Risk is actually the norm. It's our hope, our desire to have certainty that is illusory. Okay? Now, how about the word sustainable? Again, from a Buddhist perspective, at the risk, if I may, of literally giving the sermon to abbots, if I may, a true Buddhist tends to look at things from a causal way, which is something I alluded to earlier, itappacayata, because of this, and dependent origination, and so forth, the law of causal. So, what is sustainability? Well, first of all, something is sustainable simply because there is something that sustains it. Okay? It doesn't mean it lasts forever, the way Nick said, actually. You know, I can actually sustain my voice because I'm giving air through my vocal cord. I'm sustaining my guitar with my strumming. Okay? So when we want sustainable, it's not only that something sustain A, sustain B, but that A itself is somehow inexhaustible or renewable. Okay? And so if you think about it, sustainability from a Buddhism would mean that itappacayata exists. A causes B. Because A is renewal of sort, there is more of A, or A renew itself. B lasts pretty much forever. So the forever in B is not a forever in itself because B doesn't have a self-essence. B is only there because it's sustained by A. So sustainable, to be sustainable in a technical, if I may, itappacayata sense, it simply means that you have A that is on tap for as long as you need it. And A sustains B. Okay? Then what does this mean? Well, the world itself is sustainable in the sense that the biospheric equilibrium is sustained by natural process. The above average heat in the European countries at the same latitude as Canada is sustained by the Gulf, the convection stream inside the ocean. So there's a process. Why do we have water? Why do we have forest? The forest is sustained because it has a water cycle. So from, I think, a technical perspective, sustainability should never be looked as how long does this thing last, but how can we make sure that the process that sustains it is itself somehow renewable? And the world, the planet, the biosphere is naturally evolved in the way that the way you see the world operating for millions of years. Well, that's because it's sustained through certain mechanism. Now, the problem with humanity is that we become an active player. We start introducing initial conditions that were not there, like carbon dioxide emission, like CFC. So you have human being that introduce on an industrial scale factor that would influence whether or not the sustainable cycle that had been operating for gazillion years is going to be put out of balance. The good guys then would try to, well, A, detect whether or not we are producing something foreign, like the scientists who discovered the equation of the CFC and how it depletes the ozone. Okay, stop that, or come up with some sort of a mechanism to control our own side effect. Okay. So that would be a little bit of a contrast. Now this is where I give a little bit of what professional risk managers do. This is what I built my career on. Basically, the risk concept here, forget what I mentioned about the Buddhist the idea of causation, itappacayata. From the Western perspective, risk is a triplet of things. One is a possibility, meaning there has to be more than one outcome, otherwise it's certainty. Associated with each outcome, there has to be some kind of measure, and this is where the mathematician in the 18th century gave us a foundation, some kind of probabilistic measure, probability of head versus probability of tail, probability of stock going up versus probability of stock going down. And then there has to be some kind of utility. In other words, it has to matter to us. If I'm not invested in the stock market, whether or not it goes up or down, well, let's forget, let's say I'm not invested in football betting. Whether or not a team won or lost doesn't affect me, okay? Now, stock is different because it does affect me whether or not I'm in it. Okay. So there is a sense of a variability. There's a technical term, it's called random variable. Something that is that you don't know the value of. There's some sense of probability of it happening, and some of it's good, some of it's bad. You prefer one over the other. Okay. And the job of financial risk manager is this kind of risk becomes financial risk essentially because it's expressed in monetary terms. And it also arises from financial market variables. So if there's a risk of losing money from horse betting, they don't call it financial risk, even though you actually lose real money because the randomness is driven by horse racing. But if you bet on currency trading, if you bet on equity investment, those are financial variables. And the process here, now this is where we need to keep the vocabulary consistent. There is this thing called risk management process, meaning you first have to identify what the risk is. For example, the risk from the Thai currency weakening or strengthening against the US dollars. You identify what it is. Then you measure it, and this is the word I've been using for quite some time now, which is giving it a sense of probability measure. Then the third step, and this is very critical, is called mitigation. Once you have this exposure, you somehow manipulate something. And I'll talk about it, about how later. But you do something so that that uncertainty that you don't like gets tamed a little bit, gets mitigated, gets wiped away, partially at least. And then you do some kind of review whether or not what you've been doing is successful. And this is kind of a loop. So that's the risk management process. I'm not going to go into this very much, except that in financial risk, the key risks are market, like what I just mentioned, risk of investment in equity or interest rate or foreign exchange. There's credit risk, that's the risk of lending money and to a company, and then that company doesn't pay you back, or that company falls. And there's operational risk, which is a risk that there's something critical to your operation gets stopped. Okay. Right. Now, this is where it's important. The concept of risk management in the Western world, where I grew up, really, is about A, you avoid it. If you can't stomach the risk, don't stay in the kitchen. You avoid it. B, okay? What did I put down as number 2? B is insurance. If you have risk exposure in something, you insure it. Okay, there's hedging. That means that if you are exposed to something that goes like this, you hedge it with something that goes the opposite way. If this thing goes up, this thing goes down. So on a net balance, you are staying still. Okay, and then you do diversification. That's like not putting eggs in one basket. So instead of buying one stock, you buy 30 stocks. Okay, and so this hedging overlay, so these are kind of like tools. But notice that all these tools are different from sufficiency economy's concept of immunity building, because it's relying on a pre-built, on a fabricated mechanism for risk diversification, for risk hedging. Now what happened was there was a very big failure. In 2008, you can't say that there weren't risk professionals. There were very well-paid risk managers working full-time, but the risk management mechanism broke down. Things that were supposed to not move together, when they go up, when they go down together. When you hedge A with B, when you insure A with B, and A lost, you go to B to collect your money, B already went bankrupt. So you can't collect your insurance money because the insurance company went under. Essentially, that's a simplified version of it. Okay? Whereas you recognize the concept of immunity building in sufficiency economy, this is the cognition that yes, you do all the risk mitigation, all the Western regime of risk management, but you also safeguard yourself for when the mechanism fails, for when the risk models itself does not give you the signal that it's supposed to do. I like to say that in this case, for immunity in a sufficiency economy philosophy, resilience is ex ante. It's a little bit like my analogy is with the Japanese auto industry. You know, their success was that instead of producing a car and then checking for quality, they put quality as input. Well, instead of taking on financial position and managing risk at the end, immunity building is about having this kind of immunization against risk at the beginning. Now, I'd like to just give a comment that about, for this example, the Thai financial crisis. Because we got that Thai financial crisis, we were immunized against the 2008 crisis. It's like when you got chicken pox, you become immunized against the next outbreak. But the idea with sufficiency economy is, why suffer chicken pox? Why not take a vaccine against chicken pox? So this is how I think there's a conflict. I think the Western risk management concept is still too narrowly defined to take us into a truly immunity or resilience, a world of sufficiency economy. Now, I'd like to close now by saying, what about this thing about sustainable value? Now, I don't have to talk very much about this because this morning we touched on a little bit as well, saying that, I'm just going to here, that slide, there. It's saying that we have to think about sustainability as a value proposition. Now, this could mean something like the value for the company is to manage themselves in a long-term survival style, okay? But at the end of the day, you can see that this proliferation of incorporating externalities, this concept of helping humanity develop sustainably becomes an objective. Helping humanity develop and grow inclusively becomes an objective. And this is the proliferation that we were talking about this morning, that instead of having just pure profit and pure charity, you can start having this kind of like intermediate type of enterprise that incorporates all these goals. Now, so with that, I'd like to I think, okay, let me just close with that and open the floor so that if you can have a question, we can discuss at length on any other thing. Thank you.
Thank you very much.